Okay, the first technical analysis technique that I'm about to share with you in this course is the exponential moving average. This is a very powerful technique that can help you instantly determine if a cryptocurrency will go up or down in the near future. Sounds interesting, right? In terms of definition, a moving average is a technical indicator that displays the price of a security over a set period of time. It helps smooth the price data to form a trend-following indicator. There are different types of moving averages. The two basic and commonly used moving averages are the simple moving average, or SMA, and the exponential moving average, or EMA. The exponential moving average is similar to a simple moving average. The only difference is that this type of moving average reacts much faster to recent price changes than a simple moving average. That is to say, it focuses more on recent price action, so it can help us a lot better in predicting how the price will move in the future. I think it works better in a volatile market like the cryptocurrency market. As you can see, the crypto market is very volatile. Prices fluctuate wildly over time. So for a more precise analysis, we need to give more weight to recent data. And that's why for trading cryptocurrency, we'll use the exponential moving averages instead of simple moving averages. Here's what the exponential moving average looks like. As you can see on the screen, the blue line is the 9-day exponential moving average. The red line is the 20-day EMA, and the orange line is the EMA 50. So, how can we use these lines to spot market trends? There are two ways that you can use exponential moving averages. The first one is to use the moving average crossover strategy to determine market trends. How this strategy works is simple. We simply use two exponential moving averages, EMA 9 and EMA 20, and wait for the faster line to cross above or below the slower line. The faster line is the 9-day EMA, and the slower line is the 20-day EMA. So here's an uptrend signal. When the 9-day EMA crosses above the 20-day EMA and both lines are sloping upward, this means there's an uptrend. Chances are your coin's price will go up in the near future. So in this case, you can follow the trend and place a buy order. When the price increases, you'll make a profit. Simple, right? And when the EMA 9 crosses below the EMA 20 and both lines start sloping downward, this is a downtrend signal. Chances are your coin's price will go down in the near future, and you'll want to sell your coin before the price drops further to protect your money. And when the trend reverses, or when the EMA 9 crosses above the EMA 20 and both lines start sloping upward again, we'll consider making another investment because we know that the price will go back up soon. So, we simply buy low and sell high. And we'll keep doing this again and again and again. And you can make a lot of money by just buying low and then selling high. Okay, the second strategy is to use a 50-day exponential moving average as a dynamic support or resistance. Here's what you need to take into account. When prices are above the EMA 50, this moving average can act as a support that helps push the price up. So this means when prices cross above the 50-day EMA, the uptrend signal will be stronger, and there will be a high chance that the price will go up soon. And when prices are below the EMA 50, this moving average can act as a resistance that prevents the price from rising up. So when you see prices cross below the EMA 50, this means the downtrend signal is stronger, and you can be confident that the downtrend will happen very soon. What you can do now is to get out of the market as soon as possible to protect your money. If you still have no idea about how these strategies work, don't worry. We'll dive into a lot of examples in the next lecture. Okay, now let's talk about what chart time frames you should use to implement this strategy. From my own experience, the best thing about this strategy is that it works on any chart you use. If you're a long-term investor and your investment horizon is from several weeks to several months, or even 1 to 2 years, you can use daily charts, and when you're a long-term investor, your risk will be much lower. If you're a medium-term investor and your investment horizon is from several days to several weeks, you can use both hourly and daily charts. But remember, there's no low-risk option when it comes to cryptocurrency trading, as the market is very volatile. And if you're a short-term trader and you want to continuously buy and sell cryptocurrencies, you can use 15-minute and hourly charts. But I don't recommend you day trading cryptocurrency because the market price fluctuates wildly over time, so you can lose your money very quickly. If you want to be a highly profitable cryptocurrency investor, what I recommend is that you focus 80% of your time, money, and energy into long-term investments, and 20% in midterm investments. And make sure you stay away from day trading unless you master all technical trading techniques and you can afford to lose your money. Long-term investments can be some standard cryptocurrencies like Bitcoin, Ethereum, or Ripple, and some new promising coins. Midterm investments can be other coins that you find that their value will potentially increase in the future. And for the sake of your money safety, make sure you stay away from trading pump and dump coins, or coins that increase 50% or even 500% in value in the last 24 hours. Okay, before we dive into a lot of examples, let's learn how to set up the indicator in TradingView and other trading software. First of all, you'll need to add 3 exponential moving averages. In TradingView, you can click Indicators, then type Moving Average here. As you can see on the screen, we have Moving Average Exponential here. Simply click on it 3 times to add 3 EMA lines. The next thing we'll do is to change the EMA periods to 9, 20, and 50 respectively. Now click on the Gear button. We'll change this line's color to blue. You can use any color you like. And then click on the Input tab. We'll change the first EMA's period to 9. We'll do the same for the other lines. Now click on the Gear button again. We'll change the length to 20. And then click on the Style tab and change the line's color to red. We'll do the same for the third EMA. Now click on the Gear button again and change the line's color to orange. And change the EMA period to 50. Now we have 3 different exponential moving averages. The blue line is the 9-day EMA, the red line is the EMA 20, and the orange line is the EMA 50. And make sure you don't skip the next video, because we're going to dive into a lot of examples.